Difference between credit note and debit note, with examples. Debit notes and credit notes are both used in accounting to adjust or correct an invoice. The main difference between the two is the direction of the adjustment. A debit note is used to increase the amount owed by the customer to the supplier, while a credit note is used to decrease the amount owed by the customer to the supplier. Here's an example to illustrate the difference. Suppose a customer purchases goods worth $1,000 from a supplier. The supplier issues an invoice for $1,000, which the customer agrees to pay. However, when the goods are delivered, the customer discovers that some of them are damaged. The customer informs the supplier and the supplier agrees to replace the damaged goods. In this scenario, the supplier can issue a credit note to reduce the amount owed by the customer. The credit note might be for the value of the damaged goods, say $100. So, the revised invoice amount will be $900, $1,000, minus $100. Now, suppose that the supplier discovers that they had undercharged the customer and the actual value of the goods delivered was $1,100 instead of $1,000. In this case, the supplier can issue a debit note to increase the amount owed by the customer. The debit note might be for the additional value of the goods, say $100. So, the revised invoice amount will be $1,100, $1,000 plus $100. To summarize, a credit note reduces the amount owed by the customer, while a debit note increases the amount owed by the customer.